This week, house prices fall, but the market takes its breath and awaits Bank of England's cuts. What's the background to all this? Basically, UK house prices fell by 0.8% in June after rising 0.4% in May, according to Nationwide reporting on Thursday, which trims the annual rate of growth to 2.1% from 3.5. Well, we knew this year wasn't going to be huge, and it's proven to be that way. I think the issues with Mr. Trump and so on have really knocked the stuffing out of the economy. So, not brilliant. April 1st changes stamp duty combined with a broader global political volatility, not sentiment, which is confidence in the market, and meant that people didn't feel that much like, well, is it a great time to buy? So it's really knocked a bit of stuffing out of it, which is just as number of homes for sale began to rise. So there's more out there on the market as people are trying to sell their stuff. New UK listings during the 5 months through May were 15% higher than the 5-year average, excluding 2020, according to Knight Frank. Is that the same everywhere? Is the market being knocked? The north of England has outperformed the south in many recent quarters, but now the difference is narrowing, interestingly enough. Average prices in the north of England, which is the north, northwest, Yorkshire and Humber, East Midlands and West Midlands, were 3.1% up year on year, while those in southern England, southwest, outer southeast, outer metropolitan, London, East Anglia were up 2.2%, which is a bit of a strange thing, isn't it? Because, house prices are so unaffordable in the south for average people. Now we know, that any buyer has their choices. We all have to look to our own personal buying sentiment, our own personal buying goals before making any decisions. But it seems that buyers at the moment in general are a lot more sensitive to pricing. They're thinking that if I've got to pay a large mortgage and mortgage rates are going to go up, what can I really afford? Let's be really realistic about this. But at the same time, activity levels are quite robust. They're still going up. Mortgage approvals for house purchases climbed 2,400 to 63,000 in May, after the Bank of England reported on Monday, after economists polled by Reuters expected a decline down to below 60,000. So it's bucking the trends.
Sorry to interrupt, but if you're enjoying this piece of content and would like to find out more about buying property and our key 10 steps to doing so, then pop your details in the link below somewhere and grab a copy of our book, 10 Steps to 10K, the Expat Property Playbook. Enjoy.
Remortgaging rose 6,200 to 41,500, the sharpest increase since February 2024. And bear in mind, this will be a big year for remortgaging because 1.8 million homeowners will be coming off their fixed rates that they've been on to refinance in 2025, according to UK Finance. They've been on ultra low rates, which would be a painful increase for a lot of people. So let's just look at how that actually looks in real terms. The effective interest rate, the actual interest paid on newly drawn mortgages, decreased to 4.47% in May from 4.49% in April. But 5 years ago, the actual rate was effectively 1.74%. So I think a lot of people I speak to are on, say, 2.5%, and they're going to be going up to 5%, which is pretty grim from a mortgage perspective. So it looks pretty doom and gloom. More houses on the market for sure. Global volatility is out there. It doesn't paint a very good picture. But it's a strange dichotomy. When things go well, rates go down, interest rates go down because lenders trying to raise more money. But when things go badly, interest rates go down as well because you have the government trying to free up the economy. And that's where we are at the moment. Mortgage rates have been back and forth over the last 4 or 5 weeks, up and down. Lenders have been adjusting rates at the margins to manage volumes, not because of big shifts in economic outlook. But, the markets seem now to be calming down, post-Trump tariffs. There was one blimp on the horizon, on the radar, just recently, when the Chancellor was in tears in the House of Commons, and it's reported that bond markets were sent into turmoil and the pound tumbled by 1% against the US dollar, drawing comparisons to chaotic reaction to Liz Truss's disastrous mini-budget. UK 10-year borrowing costs surged close to 4.7% as Sir Keir Starmer refused to offer Rachel Reeves his backing as she sat beside him at Prime Minister's questions. $3 billion was cut off stock prices. So just goes to show really what a confusing picture it is out there and how many different things can influence what's going on. As a property specialist, I try and look into the future and think what's going to happen. And to be fair, it is so incredibly difficult to do so. All you can do really is just say, it's never a good time to buy, it's never a bad time. If you're not in it, you can't win it. It's just a case of being careful about what you are trying to do. I think now that lenders are starting to sense there's a change in the wind after a run of poor economic data. 5-year swap rates, instruments which are used by lenders to price mortgages, have dropped to 3.6%. So they see interest rates going down. And the Bank of England is increasingly emphasising the weakening jobs market over the threat posed by inflation is actually more important. So the fact that the economy is getting weaker rather than inflation, a bigger problem, is being highlighted by the Bank of England. Andrew Bailey on Tuesday highlighting that Britain's softening labour market was a problem and said rising uncertainty in the global economy had definitely hurt economic growth and investment intentions. In an interview with CNBC, Bailey said a key question of the Bank of England was how much the weakening of the labour market and the economy would help to reduce inflation pressure. So that's deemed as more important now, the weakening of the economy and a shrinking jobs market, than perhaps the threat of inflation. Bailey mostly emphasised the downward risk of Britain's economy rather than the threat of inflation, and said the Bank of England was watching very carefully for signs that the recent price increases might turn out to be more persistent. Short-dated British government bond yields touched an almost 2-month low after Bailey spoke. That increase in uncertainty and predictability is definitely coming through in terms of activity and growth, Bailey said at the Central Bank Summit in Sintra in Portugal. When I go around the country talking to businesses, which is what I do a lot, what they tell me is they're putting off investment decisions. He repeated this view that interest rates would like to fall gradually, speaking at a panel event with other central bank governors at the ECB conference. Bailey said Bank of England policy was restrictive at the moment. So he's going to have to cut rates to support the economy. And in doing so, he'll help support the housing market. It's positive news if you're a buyer of investment property. In many cases, rates have already been cut. In the last 10 days, Halifax, NatWest, Nationwide, Santander and Barclays have all cut their rates. As I said, it may be because they've got managing their market appetite, how much of the market they actually want. Perhaps they're not getting enough of it. But they're saying, economists from those 5 banks are currently saying they expect the Bank of England to cut rates twice this year, but there could be scope for a lot more. Financial market strategist Michael Brown of Pepperstone said we could see as many as 4 cuts should inflation continue to ease and the labour market continues to loosen. This would prompt mortgage rates to ease a little more and would support a fuller recovery through the autumn. So they're quite positive from a lending perspective. But I mean, if people are going from say 2% up to 5% on the mortgage, that is going to absolutely hammer them in the UK, and that is going to cut back on people investing in property or moving house, and won't have a positive effect on the marketplace. Having said that, we're looking at this from an expatriate international perspective in the main, which is where most of our clients come from, and they will be looking at, well, how does this affect me? Will the property, if I get a 6.5% yield, wash its face? Or should I look at other sorts of property, ones that are getting a higher yield than that? HMOs, supported living, those sort of things. Because there's lots of different sorts of properties out there that will give you, in many cases, in excess of 9 or 10% rental yield. And that's what we do at APW. We try and put all these pictures together. Okay, so let's look at some of the questions that we've had from recent weeks, some of the comments. Benny Buena, 754, said, 100% agree, great video. Well, that's great to hear you 100% agree. I mean, I wouldn't take everything said at face value. Quite often we're wrong because it's only our view. And went on to say, Benny Buena, don't forget the pride of giving a family home when they can't afford one. And I think that's true. When I bought my first property, I was so chuffed about it. Rather than living in a rental, I had real pride in that. I felt much better about myself. Secondly, we've got Amen at 916. Great video, thanks. Do you think a government that actually does the right thing for its citizens will cause house prices to rise? Wondering how 2029 will play out. The problem is, I think, with the government at the moment is, they're hamstrung by the fact that there's been so many decades of lack of house building. We mentioned quite some time ago that since 1947, there's been a shortfall of 4.2 million houses not being built because of the Town and Country Planning Act, which basically introduced NIMBYism. And we're still suffering from that. There's a lot of strength in the rural conservative market who don't want houses built in their backyard. It's going to spoil their views or spoil their environment. So that's the problem that the government's going to have. And also, it's way too optimistic in what it thinks it can achieve. It needs to have a much more, I think, industry-led, which is not a Labour policy, but industry-led recovery by giving industry cheaper loans, giving more training to get people back on the tools, because there's such a shortfall of quality traders since Brexit, and there's no incentives for builders to go out there and really build social housing and just the stick and carrot approach. It's mostly stick at the moment, and it should be a lot more carrot. How will 2029 play out? The way it's going at the moment, Nigel Farage will probably be in power, which will probably be an even worse situation than one we got or we had with the Conservatives. Okay, J Vincent 4854. This is good news. Let's get more selling. Eventually more people will choose to buy, then less demand from renters, then rental prices will also decrease. It's true, that would be a great situation, but it's a long, long way ahead, and I can't really see that happening anytime in the short term, especially when there's baby boomers such as myself who are insistent on holding on to their big houses when they should be selling them and moving to smaller stuff. And that's the age group who at the moment are holding a lot of the significant property wealth in the UK. So there we go, that's it for this week. Thank you very much for listening. Do hope you enjoyed. Any comments, please let us know. And don't forget to have a look at the Market Playbook. Download it if you can. There it is, lovely behind me. Property Expat Playbook. 10 steps to building an income. Thank you very much. Cheerio.